Good morning, everybody, and thank you for taking the time today to join our panel. We will be discussing the transformative influence of Africa's financial sector, or perhaps more accurate, the need for a transformative influence. This panel is going to explore the role of public and private financial institutions in increasing access to the finance for MSMEs through sharing their experiences learned from their operations on the African continent. We have a strong panel today with representatives from the DFI community. We have BII, DFC, FinFund, and we have an actual corporate, a practitioner from Action Financial Services, and more on these people in a bit. But first, let's get to the essence of the panel. And to do that, I'll tell you some things that you probably already know, like MSMEs are important. I mean, like really important. There are nearly 500 million MSMEs in emerging markets and developing economies. These MSMEs account for nearly all firms, for most of the jobs in these countries, and as such, MSMEs are a crucial source for the livelihoods of people living in poverty. MSMEs make up to over 90% of all firms, actually, 70% of all employment, and 50% of GDP. That's just to get an indication what we're talking about. Recent crises, however, particularly starting with the COVID pandemic, followed by increasing geopolitical nightmares in Africa and outside of the continent, all have had an impact on the interest rates, on the food supplies, on the way risk is anticipated. And overall, this has weakened financial service providers financially, constraining their ability to meet the increasingly stringent funding requirements. And as a result, MSMEs are seeing a credit contraction in many countries. And MSME lending is actually below pre-COVID levels in most countries. In Africa, the challenges seem to be a bit more acute even. There are over 400 million people in sub-Saharan Africa living in extreme poverty. The region has more conflict-affected countries than in any other region. Unemployment is high, particularly for the youth. And with the strong population growth, youth employment is likely to rise. This all threatens the development outcomes and the political stability. More and better private sector jobs are needed to improve the lives and the livelihoods of people in the region, yet MSMEs persistently struggle to access the financing they need, and there remains a massive credit gap. At CGAP, we've estimated the credit gap to be around $5 trillion, the MSME credit gap. And I'm aware of the methodological challenges for coming up to such a number. But in honesty, if it's 5 trillion, or if it's 7 trillion, or if it's 2 trillion, that's not the point. The point is it's a really large number, and the number is not getting smaller. On the contrary, it's actually getting bigger. The number is so large that you can say there's no silver bullet. No MFI, no fintech, no funder, no government will be able to solve this challenge by themselves. Addressing this challenge will require a multifaceted approach. To address this challenge, we must work together to move MSME finance markets in a more inclusive direction. So to discuss this problem, how the financial sector can have a more of a transformative force, I'm joined today by this excellent pool of experts. I would like to introduce. On the DFI side, we have Leila Alstrom. Leila is an investment officer with the U.S. International Development Finance Corporation, aka DFC. DFC is America's development bank and partners with the private sector to finance solutions to most of the critical challenges for the developing world today. Leila covers East Africa and is part of the Financial Services Group. Leila has been with DFC for over 4 years, and prior to that, or for over 5 years actually, and prior to that she was with USAID's Development Credit Authority for 4 years. We have Antti Partanen, an investment manager at FinFund. FinFund is also a European DFI, investing across the developing world in various industries, amongst other the financial institutions, banks and non-banks. FinFund can invest in both debt and equity. FinFund has a strong focus on Africa, particularly in the sub-Saharan region, and FinFund's goal is to enhance MSME sectors in each target country. We have Keegan Ziadi, who is an investment manager at BII's Financial Services Group. BII, which you might still know as CDC, is UK's development finance institution and has been at the forefront of supporting companies that help development and emerging countries go for the last 76 years. So unique amongst its peers, BII has the mandate to pioneer the establishment of BAI-backed platforms, and that includes actually holding majority equity positions. And with these platforms, they aim to tackle critical and unresolved development challenges. And last, we have Hassan Muhyiddin, who is CEO of Action Financial Services. Action Financial Services. With Action Financial Services, he's in charge of banking, microfinance, insurance, and private investments. Action Group is a Pan-African group operating in 17 countries and is specialized in 5 high-growth sectors, mainly telecom, energy, financial services, open innovation, and properties. And Action Financial Services try to cover the full range of services, ranging from corporate to mid-caps to SMEs to retail. They also have digital microfinance platforms and the digital banks, and they also offer insurance. So basically to every enterprise, big or small, and whatever services, Action is going to be there. Today, we will be discussing several bigger picture questions. As I highlighted in my rather lengthy introduction, MSME credit is a problem. There needs to be more of it, yet it seems that we're getting less of it. So what are the bigger picture questions? And to start there, I think we should start by looking at the nature and root causes of the financing gap of MSMEs. And perhaps, Keegan, you can kick that off for us.
Sure. Thank you, David, for the introduction, and good afternoon, everyone. Thank you for joining us. I feel a bit bad, I must be honest, to have to kind of go into the causes and issues and the problems which David has already set up, but there is some light at the end of the tunnel, I promise, as we think about what are some of the transformations that we're beginning to see. But I think it is important with this topic that we, at least from my perspective, I think we need to be really frank with some of the challenges that we are still facing. And as David's pointed out, unfortunately, this is a topic which I think has been on the AFSIC agenda for I don't know how many years, but as long as I've been coming. And yet we continue to struggle to get capital to the majority of companies in our markets. And that's a big issue, right? It's a big issue. And I think it's somewhat a stale topic, which sort of I think sometimes people get tired of. But I think it's really important that we are honest about some of these challenges. And I think I'll try to frame David's question around what are some of the root causes of these issues a little bit, but you're going to have to forgive me because clearly we're talking about micro, small, medium-sized businesses, many different markets. It's a complex challenge, but just to mention some of the, I guess, sort of more topical insights perhaps that we've come across at BII in more recent times, having had a look at our portfolio. And I'll start with the supply side challenges. So if we think about the providers of capital, most SMEs are still going to their banks for capital. That's the sort of, the primary place that they go. But there's been big withdrawal and challenges for banks in providing capital. And there are, I think, a number of root causes or issues to this. I think it's of no surprise given the kind of state at which or levels at which interest rates are at, and in particular the yield on government securities, that many of our banks are choosing to prioritize putting capital and allocating their capital there at kind of risk-free, and we had a discussion around whether it really is risk-free or not. But there's a place there for them to put capital, so it's why take the risk on an SME, which is inherently a risky segment. There's a lot of the regulatory constraints that they face, the degree to which they need to provision against some of these exposure, which limits the amount of flexibility that they can have. So most of the banks are needing 120, 150% collateral on their SME books because otherwise they will need to be taking provisions against us. I think there are complexities around the regulatory issues with banks. And then I do think that there are challenges and perhaps a lack of innovation around the types of products and financing products that one can provide to SMEs. So many of the banks, I think the products have been somewhat rigid. There's been a lack of appetite to take tenor risk, and a lot of this is for good reason, but I think what that has done is it has meant that the number of SMEs that can access that capital and the debt service burden that gets put on some of those SMEs, you have a mismatch in terms of the type of capital that a business needs and the type of capital that many of the banks are willing to offer. So I think there are challenges, and I think we need to be frank about that. I think the other avenue we have explored as BII has been primarily through our funds program, and we've had a very extensive funds program, and a number of those SME focused funds have been trying to provide capital, and that has been challenging. I think not like some of the other challenges private equity's faced more broadly, but exiting small equity stakes has been difficult. I think the private equity fund format has been a challenge in its fixed life sort of nature. And perhaps one of the biggest issues, and this is really what we have been trying to resolve at BII, is around the currency. So many private equity funds, you're raising capital from a range of international investors, you're chasing a dollar return, and that means that currency risk has to be put somewhere. And typically it's gone on to the SMEs, and that means that either you're ending up with SMEs who are managing this currency mismatch, or the universe of SMEs that you can serve is very small because it's SMEs that have got the hard currency revenue streams. So I think those have been some of the challenges on the fund side. And then I think there's a whole other world of NBFIs and MFIs. And I think it's encouraging to see some of the progress there, particularly of some of the fintechs that are beginning to emerge in the space. But again, there have been difficulties with some of these businesses scaling, and I think there certainly are some examples, but not as many as we would like to be providing the capital. So I think it's interesting to think about who are the wholesale lenders and who is providing the balance sheet to MFIs or to some of these new fintechs, allowing them to scale. So that's a lot on the supply side. There's a number of demand issues. I won't go into a lot of detail. I think we're all very aware of the challenges that small and micro businesses face in terms of financial management, governance, the lack of sort of credit infrastructure and bureaus to support them, the informality of some of those companies, which make it difficult to lend to. So a lot of issues. But maybe let me pause there to see, I don't know, I'm sure other panelists will want to add.
Yeah, I think you touched the topic of one of the issues is there's a tremendous gap for getting funding for the MSME sector, specifically amongst the major banks in Africa. There are some that are more and more coming into that place and trying to fill up the void. But still, like you said, there's a tendency amongst the banks to put their monies in the so-called risk-free assets, the local T-bills, which is it's not risk-free. But then it's a chicken and egg sort of issue that these very countries, they should start focusing on the MSME sector, because that's where the growth actually comes from and gets the economies on a steady, sustainable growth pace, employing, because still like 50% more or less in Nigeria, for example, it's I believe over 60% of the young population is self-employed. You have median age of 18 and 65% I believe are under 30. So there is a tremendous gap and challenge at the same time to finance these MSMEs. And then you have the MSME, the MFIs that are trying to fill that void, and then there's a challenge for getting funding, because there are so many, some of them are very small, and they may not have the platform ready for that kind of volumes to fill out. Then there you have the financial literacy issue, etc. So there is a tremendous opportunity at the same time for all the market players.
Yeah, thank you for that. I mean, it's a little bit on what the root causes are. There's some regulatory aspects to why banks don't do what we hope they would be doing. There's also an aspect that banks feel comfortable investing in more risk-free assets like treasury bills. Why exactly what's happening with the MFIs is something we still should discuss a little bit more during this panel, why they're not investing more, or what has actually happened since COVID. But what I'd like to hear, especially with this panel, so now that we have discussed a little bit about the root problems, what are you going to do about it? I mean, you are DFIs, most of you, and there's a corporate. You have given yourself the mandate to do something, so let's hear it.
All right,
Leila, could you?
Yeah, it's all on me. Well, again, I think there are challenges, a lot of challenges we've spoken about for at least the past 10 years that I've worked in this space. But I do think there is signs of hope, and I see that from the commercial banks I work with, and I see that through some of the initiatives that DFC has supported. So maybe I'll talk a little bit about where I see an institution like DFC fitting into it. Yes, we were under a prior name before becoming DFC. We were known as OPIC, and as I mentioned, I had come from USAID's Development Credit Authority, which focused on partial credit guarantees. But if I even see over the past 5 years how DFC's portfolio has changed since we were formed under this new agency, where the volume of our portfolio used to be, the bulk of it was in Latin America, and it's Africa now, and that has changed in 5 years. Of our 40 billion, and I'm using figures as of FY23 because the U.S. government's fiscal year just closed for 24. But if you look at the overall, as of the end of FY23, DFC's overall exposure was $40 billion US. 10 billion of that, more than 10 billion of that was in Africa. And as I said, this is new. This is just transformation has happened over the past 5 years. I think you've also seen over that time a huge growth in our lending to financial institutions. It has been a bit of a catch-up compared to some of the bulk of lending that we see from our European counterparts and IFC, but so many more projects that are happening in the financial institution space. But it's not just limited to that. We have other initiatives that are focused on, sort of more, mobilizing more catalytic opportunities and specific, programs focused on that type of lending that don't have to meet some of our other requirements. And if any of you as investees have worked with DFC or with other DFIs, you know that oftentimes we are slow, it's onerous to work with us. We have very high standards, and so oftentimes when I'm meeting with different investors, it's really thinking of, do you really want to work with us? Is this really the right fit for you? So understanding that oftentimes we are not at the forefront of innovation, but where we can, I do feel like there is within our agency a willingness to support that. So I'll also just mention, because as Keegan nicely pointed out, a lot of the challenges that commercial banks face and the reasons why they operate how they do. But I wanted to highlight 2 projects that I worked on over the past couple of years. One is with a smaller commercial bank, now sort of a tier 2 bank in Uganda, who was interested in moving into refugee financing. For those of you who don't know, Uganda houses the largest number of refugees in Africa. That number is unfortunately only growing, but have seen the financial opportunity that they as a bank can, that refugees hold, and we're interested in expanding into that. So DFC entered into a partial credit guarantee with that financial institution, focused almost solely on expanding financing to refugees. They've started lending under it already. You're looking at loan sizes of about $1,300, oftentimes under the group lending model. So that opportunity came to me through a pilot that this financial institution was willing to take with support of some other donors, and saw the opportunity and we're looking to scale it through the support of us. So, our product itself in that case is just, one of our standard portfolio guarantees, but this was the first time we've worked with a commercial bank to support refugees in sub-Saharan Africa. So, something like that where, sort of seen as not necessarily kind of your, nowhere near obviously a corporate, but not even just an MSME, of sort of seeing, identifying refugees as, as good borrowers, but needing the credit enhancement through our partial credit guarantee. So that's one opportunity that just really, came to us because the financial institution was a willing and able partner, had some, a little bit of practice doing this through a pilot and wanted to expand on it. Another one I wanted to mention was with a much more different type of financial institution, which is a project that I closed this past year in Kenya with the Cooperative Bank of Kenya. They recently signed on to a product offered by MasterCard to kind of connect the entire agriculture value chain. So as many of them, I'm sure you know about the Cooperative Bank of Kenya, many of their clients are agricultural cooperatives. Through this MasterCard technology is signing up all the individual farmers, and they can therefore see inputs into the amount of produce that they're producing on their land. They can see, the inputs required, seeing, sort of the pricing and who the players are at every step of the value chain, which is what that technology through MasterCard does, but still need a risk mitigant in that. And so we came in again with a guarantee, the largest guarantee that DFC has done in Kenya at $40 million, which we expect to, have the benefit of extending credit to not only, agricultural, farmers who are part of part of these cooperatives, but again along that value chain. And then finally, the last thing I'll mention is another activity within DFC that's sort of more focused on venture debt, looking at sub 1 million investments, but I can't say it's been easy. I can't say it's been smooth. There have been a handful of loans that have gone out so far under this activity. But again, identifying and trying to, it's again only going to be appropriate. That type of loan is only going to be appropriate for certain types of businesses who can accept a dollar loan from the U.S. government, meet our requirements when it comes to environmental and social. So, this is not perfect. DFIs are not, my kind of takeaway is that DFIs are not always the right fit, but I think we try to be, try to see where the innovation is coming from the private sector and how we can come alongside and support that. So I'd love to hear from some of the other DFIs about ways that, I know I know the ways in which DFC cannot be flexible, but I certainly see some from our other counterparts, more flexibilities that they have, and would like to kind of hear maybe from some of you about some of the other activities that you've taken on.
Yeah, sure. Happy to add just a few thoughts. And I think it's critical that as DFIs we continue to work with existing partners. So many of the banks, MFIs, etc. And I think that, at least sort of in my journey in the industry, I think we are getting better and smarter at finding ways to direct our capital, and being more innovative with the types of products that we can offer. So I think similar to DFC, BII can also do guarantee type products, but we're also now increasingly doing directed lines to banks and specifically ring fencing the use of those proceeds for SMEs or for women-owned businesses or climate finance. So I think we are getting better. But I think one of the things that we do as BII, which is perhaps a bit unique amongst our peers, is the setup of what we call platform companies. And typically that's a BII-controlled entity, so a subsidiary company. And in August of last year, we launched Growth Investment Partners in Ghana, which is an SME-focused financing company. It's a permanent capital vehicle that's providing long-term, flexible growth capital in local currency to SMEs. So sort of 3 to 7 year tenors typically to fund CapEx expansion products or projects. And with a range of sort of flexible mezzanine debt type instruments. So we've been very involved in and really have led together with a local team the setup and design of that, launched it in country. We're busy trying to raise capital from, in the process of raising capital from local institutions, so trying to get local currency capital to flow back into the economy so that we can provide local currency products to SMEs, because that's ultimately what the majority of them need. And I think as international investors, that's one of the conundrums we battle to solve. So we're trying to take some of the initial risk to set something up and to get the local markets really to function better, to provide appropriate long-term growth financing for SMEs in country. And the plan is that this would be a model that we can begin to replicate, and we're already partway down the track of looking at other markets where we'd look to roll out growth investment partners. So that's the type of thing we're trying to do as BII, I think, trying to innovate, trying to think about what new we can bring to the market where there are issues which are not currently being addressed as best they could.
Thank you.
Yeah, I guess
both. I'm just going to move on slowly to the next question.
okay.
And I will need you for that, so it's good that you warmed up already. But anyway, this is great to hear. I mean, I like these initiatives, refugee finance, smallholder finance, setting up platforms, doing local currency finance. Question in my mind would always be, how do you replicate this? How do you do this where's the impact? When is the impact going to come? These are great examples. I see the passion that you're talking about it, but how can we grow this? And I think that's a big question for DFIs, because DFIs tend to want to scale, and then they go back to their traditional financing of existing companies with a strong track record. So I'm very encouraged to hear this and like to know more about how to scale it. But let's move on. This was from the DFI sector. We also have with us Hassan, who actually represents the private sector. And the question for Hassan is really, what do you think, what's the role of the private sector in helping increase access to finance for MSMEs? I mean, in my own research, I've seen a lot of the private sector involved in investing in fintechs, establishing fintechs, a lot of venture capital investing in fintechs. Not much success, though, in terms of lending fintechs and decreasing the MSME credit gap. Still, it's a tough nut to tackle, a tough challenge also for fintechs. Mm-hmm. What's your experience here?
Yeah. Thank you, David. I will start by the global picture. In Africa, cash and informal sector are dominating the economies. We have less than 15% of Africans having access to banks, to account in the bank, to be served by the banking sector. And we have a huge gap of 85% not having any access to these financial products and services. And it's where we, at AFSIC Group, we want to position ourselves in order to boost and accelerate this financing of the informal sector. I can start by the successes and the challenges on the fintech and on the corporate side, and then on the challenges for us in this area. In the last 15 years, the mobile money operator issued from the MNO and the fintechs worked and covered the first level of financial services, which is the digital payment. It was really a good success with cash in, cash out, and P2P, and remittance to also to have this access to the world from the African to the African population. We can say today that it's a really continent success story on the digital payment. It's the foundation. They built the foundation since 2010, I believe. They started in 2020. They built the foundation, and the population in Africa, 100 million of Africans get benefits of this platform of digital payment now. And they moved to the nano finance. And they provide nano small amounts between $10 and $200 based on credit scoring. And at AFSIC Financial Services, we are operating in 5 countries in Africa, in Madagascar, Tanzania, Senegal, Comoros, Togo, and we have operation there. And I can give you to see the success of this starting in terms of financing of the informal population. In Madagascar, we have Mvula Bank, which is our mobile money operation, and now it's a digital bank. We provide, end of 2023, I asked of the figures, end of 2023, we provided more than 9.2 million loans, nano loans in Madagascar, for sure a small amount, an average of $20 US, but for an amount of more than $200 million on the nano side. Then it's really a good success in this area. Now, what's the next step? What's the challenges? Because we are covering the foundation, the digital payment, and the nano. The challenge now is to move to the micro and to the SME financing. And we worked on at AFSIC Group to build, and we worked on a new concept, to build a new concept of microfinance with our fintech named Cred, based on a concept, I can summarize it in 3 words: branchless, paperless, and cashless. Then branchless, we have more than 250 portfolio officer. I'm not a loan officer, portfolio officer. I listened on that on the last panel. Portfolio officer on the ground, having only the tool they have is a tablet, then no branch. And we reversed the customer relationship. In general, the customer go to the branch to ask for onboarding and to request for a credit. We reversed this experience. The portfolio officer go to the customer for the onboarding, KYC, and for the request for a loan. Well, there is a process, workflow process for credit approval. And then we covered the branchless. On the paperless side, when the credit is approved by the credit committee, which is a matter of 1 to 4 days. I'm not talking about a file with a month of studies to see if we can provide or not this loan to this SME. In 1 to 4 days, if the loan officer will receive an alert in the tablet, will go to the customer will sign on the tablet. We got from the regulation there, because there is a matter of regulation also, to have this electronic signature valid for the loan contract. When he signs, we send an email with the contract to the customer. And if he don't have a mail, but because in certain cases in the rural area in Madagascar, you don't have They don't have email. We create the email for them, and we send the email, and they can print it where they want in the branches or a coffee shop, etc. And we cover it with this paperless. And when he signs, we send the contract, and at the same time, we proceed to credit to customer wallet in our Mvula wallet, and we disperse this loan on the wallet, and the repayment is made with the same for customer wallet to credit at the end. Then we try to have this, well, first, on the microfinance, you have to have a proximity with your customers, and it's not fully digital. It's not like the Nano, where it's based only on credit scoring, on a big machine of credit scoring. We deploy million of Nano. In this case, we have to have this first proximity, this KYC, knowing the customer, having a good idea about his business, and then, which is interesting now, that we are working on the second step, which is the renewal, the automatic renewal of this loan. Then we need the first contact, and then after that, we boost the deployment of the credit by this automatic renewal based on credit scoring and our experience on the Nano side.
Hassan, I think this is actually truly impressive. It's so impressive that I just
do a
want
lot.
to interrupt you for a second.
Sorry.
I have one follow-up question, and I appreciate a short answer because I have a couple more questions for the panel, but why do you care? I mean, what I mean is, you're a successful group, financial group. You do corporate banking. You earn a lot of money there, probably. You do SME banking, which probably ties closer into your corporate banking. Why are you bothered with the nano loans and setting up a microfinance platform?
Okay, now it's a matter of covering the entire chain value of the financial services.
You want it all.
From the corporate side, we have a bank in Madagascar named BNI, which is the first bank of the country. We have this bank covering corporate, big caps, SME, formal SME, and retail. And we had, on the other side, we have the nano, and we build now the micro in order to cover all the chain, and we continue with the insurance also because we have an insurance company. The idea for us is a matter of synergy and how we can upgrade the customer from nano.
Okay.
He will start on the nano side with a good storing. He will move to the micro side, and if he's good, and if we have a good experience with him, he will move to the formal side. That formal to formal.
A true holistic view of what your company should be doing in the financial markets they're operating. I find that very encouraging to hear. So we started all off with the whole question, like, what can be done to increase MSME financing? We've heard some interesting examples how the DFI community is engaging in their efforts to do this, the private sector. But this is always with an investor lens, with increasing, with growing, with scaling, which is important. We do need it, but obviously there's also a risk to that. So how do we do this focus on investing and on growing and on meeting the demand? How do we combine that with critical issues as financial literacy, client protection, gender lens, and that's particularly relevant when dealing with more vulnerable populations like the refugee populations, like vulnerable populations, and et cetera. So how do we not lose sight of our overall development impact and goal when we are so focused on increasing our investments?
If I could, I mean, I guess all the DFIs, we have pretty much similar approach to investing, especially be it equity or debt investment in commercial banks or DFIs, I mean MFIs or NBFIs. It starts with the responsible lending. And then it's expectation also on, high expectation on the company we lend or invest money to, sort of that they have their client protection principles taken into account, that there is a proper setup, and that helps. I mean, first of all, as Leila mentioned, that the process for DFIs to get involved in providing a loan or investing in a company, be it Africa or Asia. It may be a bit long and a treacherous road, but once that has been established, then the company actually is capable of understanding and serving then their customers in a proper way, that client protection principles are taken into account. These micro borrowers don't fall into the hands of loan sharks, and that's also for the DFIs. It's also a reputational issue to be responsible in a way that we don't take advantage of the sort of population down who is lending, and then there is a tremendous risk that the borrowers don't get over indebted, that there is a due process. It sounds high-level issue, but it has become a problem in, for example, in Cambodia. Now that's in Asia, but still, it can lead to a situation where there's a void in finance, a liquidity drought, even that nobody will provide any capital to the MFIs or banks in those countries, and then it's a serious issue. So then what is the responsibility for these, not only the regulator to have a proper cap on lending, on lending, but also on the local credit bureaus, that there is a, to a certain extent, developing system to monitor the maximum loan that a borrower can take and the maximum number of loans. Surprisingly, I found out that, for example, in some parts of Africa, that is rather well developed and developing constantly. There can be one or at least one or two credit bureaus in Tanzania or Nigeria, for example, and they do collect proper data. And thanks to the fintechs, that there is actually very efficient way of checking these qualities of the credit quality. But then it becomes a responsibility of the actual financing company to do that and train their personnel to be basically on top of these things. And as mentioned, the high population growth, the young population that it's coming, and there is going to be a tremendous volume of that kind of demand across Africa. And not only it is a challenge, but it's of course an opportunity, and that just needs to meet, and then the supply and demand meet halfway.
Thank you. This is really interesting. I mean, there are enough challenges still that will accompany our increase in lending spurt. Any other panel members want to chime in on this?
If I could just follow on that all costs money. So that's the, not only does it cost money from the part of our financial institution that we're working with, it's time, it's resources. Oftentimes it's building these out either from a certain level and expanding them to meet our standards, or it's starting from scratch. And so I think that's one thing I've sort of experienced over the past 5 years, was that all of that kind of environmental and social review at DFC is done by a different department. And those conditions are incorporated into our, either our finance agreement or our guarantee agreement with those partners. And then we would say, okay, well, in order for you to get our financing, you have to meet this. But we weren't providing support for them to do that. And that, to me, was a huge lesson we've learned over the last couple of years, was not only providing more in-house technical assistance, but then putting together external activities that that our partners can tap into in order to meet those standards. So it's not enough for you to say, okay, you have to meet them and off you go until you get our financing. We had to provide that support to them, so through the form of technical assistance. So, and I guess the other thing I'll say is, yes, I'll stop there, actually, but yeah.
No, that go on.
No, I actually think I lost my train of thought.
Okay. I think that's great. I personally, I'd like to highlight the responsibility of board members to be very aware of what's happening in their company, not let's just look at the balance sheet and what they can derive from the balance sheet. So there's a huge governance issue which we could discuss, and the responsibility thereof. But as it is, I know lunch is being served, and I'm seeing more and more people leave the room. I hope that it's because of a lunch, not because you're not interested in what we have to say. But perhaps you are interested, and perhaps there are some questions from the audience.
They're just hungry.
They're just hungry. Please, go ahead.
ATF Finance, yes, hi, ATF Finance, we have an in-house trade fund, actually. We just lend to FIs in Africa. When you talk about those micro or nano funds, I mean, what would be the non-performing loan rates usually across the portfolio?
I think that's a difficult question because there are so many different people involved in doing digital credit to nano and micro enterprises. Some of the companies doing it, they literally just download an app which is kind of a white labeled algorithm, and they start putting out financial services there. And obviously the default rates are pretty high, but you also have a lot of fintechs which are more serious about this and which have a true development impact goal. And they also will maybe deploy feet on the street to help people, onboarding people, to explain what loans mean and things like that. But the honesty is when you approach nano lending with digital products, you will have, in the beginning, you will have a certain default rate, and you also need that default rate to train your portfolio algorithms to understand what is a bad customer, what is a good customer, in the sense like that. Overall, the industry is very opaque when it comes to these kind of informations. Yeah, what is the overall default rate? It's it's not like microfinance anymore that everybody's doing the same thing, and it's easier to measure. There's so many different people doing it in different ways. I would not be able to answer what the default rate is. I know they're good examples, I know they're bad examples. I don't know what the average is. It's a very difficult question. Maybe my panel has a better insight on this than
Yeah, maybe on the nano side, less than 5%, and on the micro side, less than 3%, if you are good.
And I guess it depends on a lot how the actual MFI or the lender, the financial institution is on top of its thing, and it has proper issuance process, follow-up, and then collection.
Yeah.
So all that needs to be in place and still respecting the customer with proper protection principles, so you don't.
I was bringing up the digital credit side of the industry here because it was about nano loans. That's what I understood. When it comes to nano loans, there are very few MFIs that really do nano loans. MFIs tend to do micro loans of a certain size. Nano loans is really an area of the digital industry by now, and that's a very touch and go area still. Just to give some context.
And I think just to add with the nano loans, I think the products are also different, right? And the approaches and the models are not all the same. So I think even to compare, NPL ratios across the board is not always that easy because the tenor risk is different, or the way they're collecting. So there is quite a lot of variance. But I think it is, in many of the models at least we've looked at, is surprisingly low often.
Okay.
It depends.
And do you put some, for institutions that are lending to those microfinance or nanofinance institutions, do you put any ceiling, any cap on at what interest rate they can on lend those funds?
I mean, I think typically there are, in many of our markets, there will be regulatory imposed rates, depending obviously on how the enterprise is regulated. So, I mean, I think that would certainly be the starting point. But I mean, we would want to, I think, always make sure that, that there is no sort of lending at a kind of abusive type rates into the market. I don't know if you have any.
Yeah, I haven't worked. I mean, I work primarily with financial institutions that are regulated. So. That's not as much of my portfolio, but certainly it's top of mind. I mean, if you come back to it, we're DFIs, the first word in our name is development, so we're looking to see that. I mean, I think we're looking more at lending for productive purposes as opposed to consumption. So that's.
Sorry, go ahead, please.
Just quickly, I know some teleoperators in Africa are providing quick loans on their own applications, and so we don't, at least FinFund doesn't touch those, so we do fund the regulated or somewhat regulated entities, because the commercial banks are more heavily regulated than the microfinance companies, but the ones that we have been, for example, funding there, and many of the co-DFIs here, we are co-lenders, co-investors in these same companies. they have more competitive terms on their loans than maybe the local, or for sure the local, for example, teleoperators in Kenya, for example.
I would just like to say this is a very difficult topic for me because, of course, I wish that everybody could get loans at the cheapest rate possible, but that's not the reality we're living in. The reality we're living in is that MFIs have a very high cost of funding themselves. Most of the funding is offered in hard currency. The interest rates have been rising. On top of that, if they want to be responsible, they have to hedge that money. So their costs of capital are already high to start with. And a lot of people think about fintechs, oh, they have a digitized platform, they should be lending at very low prices. That's not how it works either. Fintechs' costs of capital are probably higher than the cost of capital of MFIs because they cannot collect deposits. It's a young, immature industry, so everybody that lends to them will lend at a higher rate. And they're doing a lot of short-term loans mainly, which come with higher risks. So, you know, this whole question, what is an appropriate interest rate, it really requires a deep understanding of the specifics of the industry, and it's something which, yeah, you have to be careful about quickly shouting it's, I'm not saying that anybody did this, but I see in the industry people often say it's too high, this is ridiculous, but it's a very nuanced discussion, and I'd just like to leave it at that.
Yeah, but it's also, I mean, you look at the local interest rates, what they are in Africa, so there's always a premium on top of that. So, because us, we are living in the developed world and just got used to the zero interest rate, and now all of a sudden they are itching 5, now the dollar rate and euro rates down to like whatever 3-ish now coming down. But it has been a pain for many. Of course, the loan sizes are different, but when you go to Africa, sort of the small loans, even if they carry a high interest, many of these people are still happy to get, these SMEs are happy to be provided that kind of loans. They can still make money. They have their own little shops that rotate quickly. So like the short-term loans, they, on an annual terms, they may carry high interest rate, but they still provide and make a living out of it. And it's not, okay, if the annual interest rate is 20 or something, for us, it truly sounds like horribly high. It's almost like loan sharking, but that's the reality down at like where the local rates are. And they can still, on a short-term loans, their loans are rotating on like revolving credit loans, and it works.
Thanks. I think there was one more question in the room. Please go ahead.
Thank you very much for interesting presentations. My ask, I think, is specifically to you, Lena. Especially, you did acknowledge the onerous requirements on funding from DFC, as I think, as well as the slow decision making. And if I can extend that to say, even after a commercial bank has accessed the funding, the reporting requirements and other requirements are also onerous and complex. The fact is you are aware of that, and you are also aware that commercial banks do need that funding, but you haven't addressed if you are looking at those requirements and looking at ways of making it easier and simpler to access that funding, because they are required, really needed in most of the economies in Africa if we are to make a difference.
Yeah,
Thank you.
It's a good point. I mean, I think you always have to think about trade-offs. Okay, so if we lower our environmental and social standards, what are the trade-offs for that? We have a reputation. I'm responsible to the US taxpayer for the investments that I make, so they expect a certain level of that. So, you know, expect those to be made at a certain level. So I think you have to think of what you're giving up by that. But it also, again, I mean, one of the things that I struggle with a lot is then how does this inform the types of partners with whom I can work? I don't always want to work at the top with the top tier banks. That's not who I think is doing the most progressive work. The top tier banks have their own, their own challenges with bureaucracy, with sharing of information, with policies, and the constraints they have on themselves. In my perfect world, I would be working with the tier 2 banks who can still meet our environmental and social requirements, but are still the ones who I see sort of pushing, to the extent that they can, pushing the needle with SME lending. So, there's going to be trade-offs. So I guess maybe I would put the question back on you. What do you think I should, what should I be, what trade-offs should I be making? Where should I be, in which ways would it make sense for me as a DFI to be, lowering certain standards? Where, or if there's, I often hear all, again, what the challenges are, but it would be asking my partners to come to me and say, okay, this is where we see the challenges, and this is my ideas for solving that. And I have to say, oftentimes, and I don't know if this is if it's cultural, if it's that me coming in as an American DFI is sort of like it's take it or leave it. But I would like to always be at a point with my partners where they can approach me with their ideas to fix that. So yeah, and maybe not a great answer, but that's kind of where I think understanding what my perspective or what our perspective is coming from, our responsibilities as well.
I think it's the reality.
Yeah.
Okay, I think I could squeeze in one more question if anybody has this desire. I'm looking against the light, so you have to really wave. There's nobody? Okay, then I guess that's it. I'd like to thank the panel for the great conversation. Thank you very much.
Thank you.
You can clap now.